Hello and welcome to the Allianz Global Investors Office in London. Today's subject will be Structured Alpha, the Alpha Engine. I have Peter Pilavacci with me, product specialist for the Structured Alpha franchise. So Peter, let's go back to the beginning. Why don't you tell me a little bit more about the strategy's history?
Sure, Nikki. So the Structured Alpha franchise started a little bit more than 12 years ago. In 2005, we started trading this strategy. Back then, we had two big goals. On the one hand, we wanted to beat T-bills by 5%. And on the other hand, we wanted to beat the S&P by 2.5%. On the other hand, one very important topic was the fee structure we wanted to charge. We wanted to charge zero management fee and charge only if and when we outperform our benchmark. Since then, we charge 0% management fee and 30% on performance if and when we beat our benchmark. Finally, the last point I want to pass on is that we currently manage about 11 billion of assets, so that's real large.
So before we go into specifics, could you explain, generally speaking, how you generate alpha?
So what the team does is that we invest in options, and specifically we invest in options on the main US equity indices. We trade options on the S&P, on the Nasdaq 100, and on the Russell 2000. It's important to notice, right, these instruments are the most liquid instruments available in the derivative market. On top of that, we also trade options on the VIX and on the VXX. The way the team trades these instruments is a hybrid between discretionary and systematic. Discretionary in the sense that every option we trade is handpicked by one of our traders, by one member of the team. It's also systematic in the sense that we use our statistical tools as a decision-making tools to decide which options we should trade. So we're really a nice hybrid between discretionary and more systematic. Finally, I think one of the great attractions of what we do is that since we trade options, our alpha tends to be nicely decorrelated in comparison with traditional asset classes and specifically against equities and fixed income. And therefore, alpha should bring nice diversification benefits to a portfolio.
Now that we've looked at the big picture, could you drill down into the strategy and how it generates alpha more in detail?
Sure. So the premise of the strategy is to be long and short options at all times. We have always been long and short options every day of the year since we started 12 plus years ago. That's really important to keep in mind. Apart from that, the strategy invests in three types of positions. Type number one, we call them range bounds. Range bound positions are really designed to make money in normal market conditions. What we do there is sell options in order to cash in the premium of these options. What we really do in practice is set up profit zones and hope for the market to trade within these zones until maturity in order to make money. These positions are really the main performance contributor of the strategy since inception. The second type of positions are called directionals. What we do there is position the portfolio for a large market move, either up or down. The goal of these positions is really to help us in case the market makes a genuine move outside of its usual market trend. The third type of positions are our hedging positions. What we do here is hedge the portfolio for a real market crash. And what we have in mind specifically is October 87. What we do in that bucket is buy puts in order to hedge for that crash. What is interesting also to note is that our portfolio always has more long positions than short. That's the way we run our portfolio. And if you want to summarize this, we trade these three types of positions with, of course, in mind the goal to generate alpha while managing risk.
So could you summarize where the real alpha generation is and how you mitigate risk?
Structured alpha and the alpha engine is really about generating performance by selling options. But as we all know, right, selling options may be risky because we are short. And therefore, we will want to mitigate that risk. In order to do that, we have three safety nets. The first safety net is our systematic risk management approach, whereas we restructure or relayer the risk further away from where the market is in the case where the market moves against us. The second safety net is our directional spreads that make money when the market makes a move, which is exactly when our short positions might be more difficult to manage. And finally, you could call it our ultimate safety net, is our layer of crash puts that we're long in order to protect the portfolio for a genuine market crash. And therefore, you can see, right, that we are short options to generate premium, and at the same time, we're long options in order to mitigate the risk.
And what has been the outcome of the strategy to date?
The outcome of the strategy is that we have managed to deliver consistent returns and managed to reach our target since inception on average. Very happy, obviously, about this outcome. Also, the returns that we have generated tended to be nicely decorrelated with other markets, as mentioned before. Also, I'd like to mention that there's really two applications for this strategy. Either on top of a T-bills portfolio, and that would give you an absolute return strategy, or on top of another portfolio, say a passive S&P portfolio, for instance. And what we would be able to deliver there would be a return enhancement portfolio. We are able to do both, of course.
Thank you very much for coming.
Thank you.